Hey there, happy Friday. Got a question for you. What investment return would you like to receive on your investments? What do you think is an accurate number in the current economic climate that we live in? That's the topic for this week's Friday wrap. Investment returns. What's accurate? What's reliable? What should we be basing our assumptions on? So investment return expectation. A survey of 1,000 people in Australia found that they were looking to return about 8.9% per annum over the next 5 years. Now, everybody knows the state of play of the world at the moment. Everybody's talking about, hey, when JobKeeper finishes, there's going to be businesses going, out of business left, right, and center. All this sort of stuff. Coronavirus has really thrown a spanner in the works. What's going to happen? What effect does that have? Current, short term. What effect does that have long term? And this sort of thing. So with our Your Wealth, Your Way modeling, one of the things we do is assume a return on your investments. We say, this is how much you've got in your investments. Say it's your super, for example. This is how much that you're contributing. You're going to work for this many years. It's going to become, how much, but it's going to grow with the investment growth. What assumptions are we using for growth? One of the things, quick story, that I have found working in the job that I have, when I talk to people about investments they make, when, let's call them, they make speculative investments. They might lend money to someone who's going to create a whiz-bang product. They might lend money to someone who's going to buy a property, in an island somewhere and turn it into, the next best thing, and they're going to get all this money back. They might invest in something which is, normal, but has higher than what you would expect to be interest rates, the old too good to be true story. In all of the stories that I've got, I cannot tell you one where the clients have got a cent of their money back. That's the reality of it. So we're all about making sure that the assumptions that we predict are conservative in their nature, based on what has historically been achieved, based on what we consider the world to be at the moment. So we are in low inflation, low interest rate, a low growth environment. And so it's important to have expectations that are realistic in relation to the market that we live in, the environment that we live in. So as an investor, you can set up your investment portfolio, in a number of ways. And the ways you set it up is how you balance growth assets with defensive assets. So growth assets, things like shares and property. You might have Australian shares, you might have international shares. Same with property. Defensive assets, cash, bonds, term deposits, things like that. You don't have the growth or the volatility, but you do have security with defensive assets. And on the other side, you do have more volatility, but you're going to hope to have more growth. And you can see there 5-year returns to 30 June 2020, a conservative portfolio, which is 25% growth, 75% defensive assets, 4.85%, all the way down, moderate balance, to an aggressive portfolio, 100% growth assets, a 6.57% return. Now, coronavirus, as well as throwing a spanner in the works for people all over the world, caused our market to fall by 30% in February and March. Now, it's come back a long way since then, but we haven't reached those highs. So this 6.5% is not a bad return, considering, in the first half of this year, the market was down a considerable amount, but it's certainly not this 8.9% that people are hoping to achieve by, just playing a smart, long-term, easy does it approach to investing. So chasing the promises of high returns puts your money at risk. Like I said in that story a couple of minutes ago, I cannot think of an instance where a client has gone and made a speculative investment and made their own money back, let alone the promises of the 20%, 30%, whatever it is, returns. And as I'm talking, I've got more stories coming to mind where it's happened to, good friends of mine. We're going to do this, property development, invest the money, this and that, whatever it was. I'm not down on property development, don't get me wrong. This is just the stories that I've got of real life examples. So we're all about, playing it safe, investing appropriately, investing to your risk profile, and assuming the returns that you've got. It's a little bit more conservative, but historically, the money's there at the end of the day, which is when you're going to need it. The risk hasn't been too high. So that's our little take on investment returns for today. Hope that makes sense. Next week, we will talk about these different profiles and how you can determine where you are or where you should be based on everything about you, your age, your income, your assets, your liabilities, whatever it is. So that's what's going to be next week. We'll follow on from this one. All right, guys, leave it there. Happy Friday.